Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Welcome to this new episode of Fixed Interest, a podcast of Fitch Ratings. I'm Henrik Poiseau, Global Head of Investor Development at Fitch Ratings. Recently, something happened that we hadn't seen in nearly 30 years. The United States and Japan intervened jointly in currency markets to support the yen after it fell to a 40-year low against the dollar. The dollar-yen rate is now back at 158, which happens to be close to Fitch's end 2026 forecast. But did the intervention actually fix anything? To answer that, I'm joined by Jessica Hinds, Director in Fitch Economics teams and co-author of our new report on Japan and the yen. Jessica, welcome.
Thank you. Great to be here.
Jessica, a joint US-Japan intervention in the currency market is a fairly rare event, and it seems the markets treated it as a kind of turning point. What's your view on the intervention itself?
Well, I think it's quite clear that the intervention has treated the symptom and not really fixed the underlying problem. Yes, it's pushed the yen off its lows temporarily. We've already seen the currency lose ground yet again. Both finance ministries have signalled they're ready to do it again, but even so, the yen remains historically weak. It's not just against the dollar, that's on nominal and real effective exchange rates. So that means it's trade weighted, it means it's adjusted for consumer price inflation. And I think also tellingly, positioning data show traders have built large short yen positions prior to the intervention. Now, our forecast of the yen appreciating to 153 by end 2027, that's explicitly contingent on something else. That's further rate hikes from the Bank of Japan. Intervention is buying the authorities time, but it really doesn't change the fundamental story.
So the story itself, the standard story has been that the yen is weak because of the rate gap with the US. Your reports say that story no longer holds. So what is really going on and what is driving the yen now?
Yeah, it's been a big change actually since about April 2025. The yen has weakened even as differentials have moved in its favour. Now, if this was a pure rate story, rate differentials, relative stance to monetary policy, the yen should have really been strengthening. So clearly, other forces are at work. The first is capital leaving Japan, carry trades where investors are selling yen to fund riskier assets like US equities. Perhaps more telling, domestic investors are looking overseas for higher real yields because inflation expectations at home have been rising over the past year. So it's the same things going on. It's just, Japan, domestic actors and foreign investors as well. Now, on top of that, we've also got market concerns about the government's fiscal strategy and then more recently, Japan's position as a net energy importer. So that's a structural drag. And the yen weakness has really become a story about credibility of the fiscal policy, real returns, and it's not just about relative monetary policy.
So which brings us to the question of reflation. The policy rate has gone from minus 0.1% in 24 to 1% today. And yet you argue in your report that the Bank of Japan is still behind. So why that?
Well, I think that's because real rates, so that's nominal rates minus the headline inflation rate, still very negative in Japan. Inflation's been above the BOJ's target for most of the past 4 years. Price pressures are now clearly entrenched. We've got a tight labour market, solid wage growth, rising inflation expectations across households, businesses, and financial markets. This is really a regime change in Japan. It's not a cyclical blip. And the Bank of Japan acknowledged that in July, saying it will continue raising rates. Governor Ueda even suggested that hikes would be discussed from September, the next meeting. Prime Minister Takaichi wants policy to stay supportive, but with a stronger yen would reduce the country's high energy import bill, which is quite attractive. So the direction of travel really is quite clear for monetary policy. And then I think the other thing we've also been talking about quite a lot is that, negative real rates have been pushing Japanese institutions overseas in search of yield. That's a really long running story. But at some point, as real rates shift, those calculations change and domestic assets become attractive again and Japanese investors start repatriating capital. We've already seen foreign investors heading into Japan in search of returns. And if Japanese investors also start repatriating capital, given how significant their overseas holdings are, that would matter well beyond Japan. That's a real global shift there. And the asset allocation implications of that are really significant. And Fitch Ratings will be publishing further research on that very question.
So to close, give us a Fitch call and the risk scenario on rates and the currency.
So in short, we think the Bank of Japan waits until October, no September rate hike of 25 basis points in October, and then another 50 basis points in hikes in 2027. That's more than financial markets are currently pricing. That path should stabilise, support the yen, but not take it back to 2019 levels. The risk is asymmetric. If the markets perceive the Bank of Japan is falling behind the curve on inflation, currency weakness will return and no amount of intervention is going to offset that.
Thank you, Jessica. So the exchange rate is now a measure of the BOJ credibility. That's the line to remember.
Subscribe to Fixed Interests wherever you get your podcasts.